John, Mary, thank you for coming into the office today. I hope the drive was pretty easy. It was good to finally meet you in person and see you here in the office. I think, like a lot of us, we feel like we've been trapped inside by COVID for a couple of years or so now. So it's nice to be back out. Um, Looking forward to talking with you today about the financial plan that we have prepared. But first, please have a seat. I have got some coffee on the table and some donuts if you like, and we'll dive into it. Basically, feel free along the way to stop me with any questions that you may have, and there's probably a few that I'll have back for you. But first and foremost, I mean, purpose of this plan is just to assist in your uh, to meet your financial goals and then to improve your financial situation. And in front of you, I have a copy of the report that I've prepared. So we're just going to walk through it step by step. I'll stop along the way and see if there's any places where we can help or explain more. But fundamentally, um, and correct me if I'm wrong here, we had a few goals that we wanted to take a look at in particular, whether it be reducing your estate tax, reviewing your insurance contracts, reducing your personal income taxes, and as well as taking a look at your investment portfolio based upon your risk assessment today. And as far as your risk tolerance, I have that as pretty much you enjoy you're comfortable with the risk of investing in individual stocks and mutual funds. I did denote that you wanted to stay away from tobacco stocks, which is fine. And in fact, most of these really won't go there. But as part of this plan, we're going to take a look at, there's a few sections in here that we're going to dive into your overall financial health, your insurance planning, your investment planning, tax planning and estate planning, and then the actions that I would most recommend, the most urgent actions for you to take. And then at the end, I will provide you. I'll need to grab a signature for you just to make sure you have acknowledged receiving this plan. And basically, what that plan acknowledgement does, it outlines what your role is in this, as well as my role and what the expectations are. Any questions at this point? If not, I'm gonna dive into this. There's also, I should add, there's a few additional documents that I'm going to attach as well, just running through some of the calculations we made, just so you have that and can look through it and see if you have any questions there too. And by the way, how's the grandkids? Everybody doing fine still? That was it was nice to see that from your family profile that everyone was in good health, and hope you're taking advantage of the retirement time now to have some enjoyment and do some things that probably you just didn't have time to do before. So first off, if that's all good, if you're okay, we're good, comfortable. Let's get into your an overview of your current financial situation, which congratulations is very good. I've totaled up your net worth at nearly 13 million at this point, which is awesome. It shows the hard work that you've put in over the years. And your disposable income per year right now is currently $284,000 roughly. You together have a sizable net worth, and I did run some quick ratios that we use to really look at things like your your near-term income versus debt and your current liquidity. So I took some measures there, and your current ratio, one of those ratios, is really high, which compares your assets to those liabilities, which is great. We also did an emergency ratio fund, which is always good to take a look at as well. And we did subtract out the $40,000 of near-term liquidity that you need for a new car. Hopefully, have you picked out which car that you'd prefer? It's always there's a lot of options out there, but we calculated this, and you have uh, over a couple of years of emergency fund uh, coverage. So that's viewed as very healthy and good. So there was a few things I wanted to point out. Longer term, your cash inflows will reduce substantially after, and this will come in 2030 once um, the note on John's business is fully paid off to you. That's not an emergency. It's just something I wanted to point out. So that's obviously pretty sizable amount of money coming in each year currently. But you know, just looking at your disposable income over the next 8 years, just by saving a portion that's like $2 million, that'd substantially bolster your cash position for years beyond 2030. So that's something we should take a look at. But yeah, just wanted to point out it's not an emergency, but you will see a reduction in income in the future because of that. Some additional recommendations that I have is you should consider paying off the remaining mortgage payments on the vacation home. I think I calculated it out. That's roughly about 20% of your disposable income today. So it's not a major hit, and it will certainly get uh, it will reduce your need for cash in the future, and that will give you additional funds to invest or to use as needed once it's paid off. So that's something I would certainly recommend. Um, and I'm going to talk about this a little bit later as we get it into this more. But you could also consider establishing 529 college savings accounts. I'm not sure if you're familiar with those, but those are basically savings accounts that you can establish specifically for college funding or even primary school these days. And that money will grow tax-free uh, for uh, for the student. And I had your grandchildren particularly in mind, and we're going to discuss that in more detail. But that's something I think we should take a look at. And as far as implementation, there's it's really very straightforward here. To pay off the remaining home loan on the vacation home, you just need to ask the lender to obtain the necessary payoff amount. Um, I would say I would also recommend that probably in your planning process that you should consider the purchase of another um, new car sometime within the next 10 years. And you could establish a checking or savings account, to maintain funds for that, or you could just use your general funds that you have today. And then finally, if you choose, and we'll talk about more, of course, of the 529 plans, those can be established at a brokerage, probably the brokerage you have today. And we could, discuss that a little bit more and get into further detail about that. But those are pretty straightforward to establish. Any questions on that front? We're all good? Okay. Great. So let's go to insurance planning because I found a lot of things to discuss in the insurance planning, and you had some particular questions with your insurance planning. So if we're all good on your general financial health, let's take a look at that. Definitely found some strengths and some things that we could dive into further for your insurance planning. So you've done a great job in terms of you maintain homeowners insurance on your primary and your vacation property. In addition, you do have a universal life insurance policy. You have automobile insurance. You have health insurance. You have an annuity policy. So you're off to a great start. Um, Here are some things that I recognize that we need to take a look at. One is, for your primary residence, because of its value, um, you need to have more insurance coverage than you do on it today, based upon the value of that property. So, you should carry at least 80% of the full market value. So today you have $400,000 worth of insurance on that. I would recommend increasing that to at least 620,000, and that would get you up to the 80% of the current property value. And if you want to offset some of the policy increase because of your strong financial position, I'd be very comfortable with you increasing your deductible on your home insurance from the current $500 to $6,200. Because to be honest, you really don't want to use home insurance policy unless it's a significant expense. So it'd be more than comfortable, I think, for you to increase that deductible amount. So that would help offset, hopefully, the rise in your insurance costs by doing that. Second, I think you should look at insurance for both your boat and your trailer. I think you have those at your vacation home. Those items have pretty significant value, and there also could be a source of liability to you as well. And most of your home insurance policies have very minimal coverage for those sorts of things. So, you should verify that with your insurer and maybe take a look at a additional policy or additional coverage for those items. And then third, and this is a really important one as well, I would recommend getting an umbrella insurance liability policy. So think of it as that is liability protection for you that goes beyond the liability coverage for your homes or for your automobiles. And due to your net worth, you have significant net worth, which goes well beyond your current liability coverage that you have on those properties today, as well as the cars. I would actually recommend maybe a $10 million liability policy. These policies are actually not particularly expensive. So you'll typically pay a couple $100 or so for the first $1 million of coverage, and that's a decreasing amount for each additional million from there for the year. And the other thing that this might also prompt is it may force you to increase the liability coverage that you have today on your homes as well as your cars, and consider your boat in this as well. So your insurer could verify that, but obviously we want to grow your asset base, but protecting your existing asset base is probably job number one. And this is a very effective way to do that. Another area that I think we should take a look at on insurance is due to the value of John's stamp collection. Collectibles insurance should be considered. Here again, your typical homeowner's coverage is going to be inadequate to protect such a valuable item. So here again, please verify. I would recommend verifying with your insurer to see if they provide that type of coverage and take a look at that policy. Finally, John, you had posed a question about long-term care insurance. This is a really tricky area. And there is risk. Many individuals do end up needing long-term care. Unfortunately, the long-term care insurance market is broken. There's very few providers left in it. It's very expensive coverage. And probably the worst part is that you can't guarantee the pricing that you're going to be charged year to year. Take on top of that, there's restrictions on how you can use that money oftentimes. So that money has to be spent in certain ways and paying certain types of providers. So I honestly don't recommend anyone purchase long-term care insurance at this point because of the condition of the market. So there are some alternatives to the long-term care insurance that I would consider. One is a deferred annuity that could be established, and some of those you can add a long-term care rider So that's an area that can be used for critical illness, or you can get critical illness insurance in addition, or just self-saving for that. So I think this is definitely an area we should discuss more. But it is an area of vulnerability out there, but it's an area too that doesn't have a lot of great market solutions today. So these other alternatives, whether it be self savings, whether it be critical illness insurance, whether it be a rider on a deferred annuity, are the ways I would recommend today, to go address that. So I'm gonna put that in the end as an action item that we should dive into, but those I think are the best options today. Any questions on that front? Okay, thank you. Um, so let's get into your investment planning. You have significant assets, both in your qualified and non-qualified funds. So think of those non-qualified as, private savings, private investments versus qualified, things like your retirement accounts. You have a significant amount of money in each of those for both of you, and you did a great job, by the way. Um, and I've denoted values in here for those. But there are some things that we can do, I think, to improve your investment position and to accomplish a couple of your goals. So if we're all good, let's dive into those. So one, your stock and mutual fund portfolio combined have slightly underperformed the market as a whole. So it's not far off, but it's a little off, and there's a few things we could probably do to improve that. The investment in stock A in your portfolio has been probably the primary contributor to this. It's lost most of its value over time. Happens. Um, I recommend probably as a way that we could use this to our advantage is I recommend selling at least a portion of the shares held in stock A each year as part of a tax harvesting strategy. So you can create up to a $3,000 offset per year to any capital gains that you have. And this would obviously help lower your federal income tax as well. And losses above $30,000 could be rolled into future years to be applied against capital gains in those years. So that's one step that we can take, I think, to improve your investment mix. Secondarily, your bond fund for its risk level has underperformed your balance fund. And so I'd recommend reducing exposure to that fund by selling some or all of it. And this could be a great way to pair this up with stock sales of stock A. So you could offset some of the capital gains that you have from selling those, that bond fund. Um, and then, of course, where to reallocate those funds. Funds could be reallocated to a balanced or growth fund. Those funds have, for the risk levels, perform better, and would also help grow your portfolio over time and achieve some of your long-term financial goals. You could also take an alternative path and invest some of those funds in a municipal bond fund. Um, the municipal bond fund has the advantage of reducing your federal income taxes as well as sometimes your state income taxes. Um, so that's another option there. We'll discuss that a little bit more in our action plan in terms of the trade-offs there. But those are two alternatives that you could use to alter that portfolio mix to get a better return for the given risk level that you're taking. One other thing I want to call out, and you haven't reached this point yet, but John, you're the closest at 72, which is next year. You will begin to be required to take minimum distributions from your 401k plan, and you'll have to do this by April 1st, 2024. So I think at least when we get into next year, we should start planning for this. I have some ideas on, we'll talk about a little bit as we get into the plan too, of maybe ways we could reduce the tax liability for you at that point. Mary, you're still a few years a few years further away from this as well, but it will come up eventually too for you. So that's a overview of the investment plans. Any questions at this point? Um, if not, great. We will go into tax planning. And um, before we get too deep into this, John, you had a question in terms of if you held your stamp collection for another 10 years, what would be the tax impact of that at the sell date in terms of um, how that would be treated. So, basically collectibles, the long-term rate on that is 28%. So based upon projected growth and value, today's tax rates, the capital gains tax would be 315,000. So it would be substantial, but you know, uh, to offset that, if the collection grows at that point, you will have a collection that's worth a million, over a million point five. So not bad, right? But yeah, that was because that's a capital gain, and the capital gains for collectible is set at 28% today. That's 315,000 is where that would wind up. Um, as I now going down a little bit further into more of the tax planning, as we talked about a little bit in the investment portion overview of this, you could make investments in municipal bonds to reduce your federal and potential state income taxes. However, I do want to note here, I really only recommend this for your underperforming assets like your bond fund as a reallocation of that. Um, there is a trade-off between reduction of your taxes and growth of your overall portfolio. So considering your level of risk aversion, which you're comfortable with stock and mutual fund investments, and you have good liquidity and good cash on hand. Um, I wouldn't recommend that as a general overall strategy, except for getting rid of a underperforming asset like the bond asset fund. Um, so second, also want to point out, you have your vacation home. You could rent that up to 14 days a year, tax free. So that would be, a potential way to pull in more income without having any, tax burden for doing so, which is great. It's essentially free money, which is always nice. Um, I would recommend though, if you wanted to take a look at that, to check with your home insurer just to make sure your home insurance policy covers that, because we don't want to open up another avenue of liability, which our umbrella policy could help with that as well. But we want to make sure that you're properly insured if you kind of choose that option. But it is something out there for you to consider. I would also consider rolling your 401k and your 403b accounts into a traditional IRA. And this is where we, I think, can talk a little bit more about your required minimum distributions. So there's a few advantages for holding an IRA versus holding investments in the 401k and the 403b. One of the advantages there is that you get a generally broader array of investment options. So that's a good thing, but it's not really the primary reason why I would recommend this. Um, if you have some charities, and we haven't discussed this, but I just wanted to lay it out there. If you have some charities that you're planning on contributing to in future years, we could establish a charitable trust to do this, and you could direct a portion of your RMDs through this trust to those charities. And you can do up to, each of you could do up to 100,000 a year. So it's a lot of money you could direct through there once you reach the age where you're taking required minimum distributions. And the advantage of doing this would be that this would satisfy some or all your requirements for the RMD withdrawals that you have to do each year, because there is a penalty if you don't do them. So we want to make sure we get the RMDs done. But if the portion or all of that RMD that you ran through the trust would not count as income to you, so it will reduce your federal income tax exposure, while also, satisfying those charitable contributions that you were looking to make. So I would only recommend this if there was some particular charities that you were planning on doing donations to, but this would be a way to solve a couple of potential issues, all at once, right? We would lower your federal income tax for the RMDs that you're required to take, while also satisfying the contributions to those particular charities that you were looking to make, if you so wanted to. So that's just wanted to bring that up. The other thing I would like to just to say offhand is we have some clients where we would recommend doing early withdrawals from these retirement accounts to lower the RMD requirements that would have in the future. In your case, I don't recommend doing that because you're already in the highest federal income tax bracket, so it's not, that's not going to help you that much. Coupled with, sometimes we would recommend doing Roth conversions. So you'd pay tax now and uh, transfer some of that money from one retirement account into a Roth account. Um, some of our clients that makes sense for. That way, with Roth accounts, of course, if you pay your taxes now, when you go to withdraw your funds, and when you go to withdraw those funds and earnings in the future, those earnings are tax free at that point. But here again, because you're already at the highest federal income tax rate, if you tried to do that conversion now, you're converting already at the highest tax rate. So I think, and not, it's possible tax rates could increase in the future, but not knowing that, I don't see a huge advantage to doing it. So just wanted to bring that up because some of our clients ask, and for some of our clients, it makes sense to kind of do one or both of those strategies. But in your case, I don't see any value there or any known value. And then the last thing, and this was a question you had as well, on the installment note, there is a way to reduce the capital gains tax liability. And that would be if you rolled those funds into a qualified opportunity fund within 180 days. And I've provided a link to give you a little more information about what a qualified opportunity fund is. Um, Basically, it's a way that you can transfer the gains from sale of a business or property. It's in some ways kind of similar to a 1030 exchange, but you're taking funds from there, you're putting it into these qualified opportunity funds. They're usually investments in areas that need development. They're sometimes low income areas, areas that the government has targeted for needing investment. And it gives you a way to move those funds into another investment and to push out the capital gains, or to be able to totally avoid them for years into the future. So I've put a link in here for you to read up a little bit more on that. Um, I think as one of our to-dos after this, if this looks like an option that you want to take a look at and pursue, obviously we've got some time constraints here, so we would need to get moving on that. But at that point, I believe we really should engage an investment specialist in this area, um, to explore that option if it's something that looks interesting to you. But it would be a way to lower your tax exposure on the funds you're receiving on the installment note. Okay, great. Yeah, thanks for asking about that because that's a very interesting area to explore. So finally, I want to get into the final part of the estate planning and then to wrap up with our action plans. Um, finally, I want to we need to say that the estate laws as they are written today, um, you're below you're not at a point where you would set off the estate tax for the current asset base you have. That being said, the current laws expire in 2025, so it could revert back to a lower amount of estate tax exclusion. We don't know what's going to happen with that yet. It's probably something we should talk about in more detail, I think, rolling into next year, just to see where things are at. But for right now, you don't have any estate tax exposure. That being said, your current asset base could grow to the point over time where maybe you will at some point in the future. It's just something that we'll need to, kind of keep an eye on year to year. But today you're fine, and we can do some planning, but we don't know what we don't know for the future. So I just want to bring it up here again. It's not an emergency scenario, but it's something you should be aware of, and it's something we may have to um, more aggressively approach in the years ahead to reduce down your tax exposure as much as we can if that becomes an issue. There are some areas over today where there are some concrete things we can do. There are some portions of your assets that are if one of you were to pass, and hopefully that won't happen for years and years, of course, but there are some areas that we could do more to protect you from probate fees, and let's kind of talk about those. So I'm not aware of any estate planning documents you have in place outside of the wills that you have today, such as powers of attorney or healthcare proxies to manage your affairs, if either of you were to become incapacitated. So I have some particular recommendations that I think we need to do. One is to address those. Two, we should change the title on your vacation home and autos from sole ownership to tenancy by the entirety to avoid probate costs. Um, these changes would automatically transfer the property from the surviving spouse, well, to the surviving spouse from the other spouse who was deceased. And this would be compatible with your objectives. We should engage an estate planning attorney to obtain the powers of attorney, healthcare proxies, and take a look at this on the titles. Two, as I mentioned, we should take a look at establishing 529 plans for your grandchildren. If college is an expected part of your family, if this is something that you were looking to contribute to anyway, this would be an effective way to reduce the size of your state as well as to provide for your grandchildren's education in a tax efficient way, both for you and for them. As mentioned also earlier, we could consider establishing a charitable trust at a point when your RMDs are required if you had some charities in mind that you wanted to contribute to. Here again, this would be a really tax efficient way to achieve that goal. And then as far as implementation for this, appointment with an estate planning attorney, it's not something I can do personally. Is needed to accomplish the estate planning objectives, and I would recommend doing this as soon as possible. They can provide a cost estimate, but generally, from past experience, I would say this runs less than $10,000 in lawyer fees and documentation fees to do this. So if we're all good there, and thanks for sitting through this. Finally, for the action plan, I really like to pull through here and pick the 5 highest priorities. One, first priority, I would recommend visiting that estate planning attorney as soon as possible to get the documentation and title works done. Would it be possible to, set up this within the next couple of weeks? And if you don't have an estate planning attorney, which you do have some wills, but if you need a recommendation there, I can refer a few lawyers that some of my clients work with in the past, and you can speak with them, and they can help you do this. I would also recommend scheduling an appointment with your insurance provider as soon as possible. Would that be possible within the next couple of weeks, or maybe at most the next month? Because I think there's a lot of changes there and a lot of recommendations that we need to walk through there. And I really want to make sure that your asset base is protected. And we've identified some areas where you might have some exposure. Three, we've identified some recommended changes in your investment portfolio. I would like us to get back together and meet maybe next month. If this time works, we'll just set this time aside and dive a little deeper into that. Yeah, I can build some recommendations upon what we've brought up here in the plan. And we did identify there is a trade-off potentially between lowering your tax liability versus growing your portfolio. So I want to give you a little time to think about that, to see which direction we can take, and I can make recommendations on both. And then finally, maybe not next month, but as we roll into, I would say at least by the midpoint of next year, um, we should, we should sit down and reevaluate your state tax liability, check and see if there's any changes legislatively that's floating around at that point, as well as I think it'd be a good point to start discussing the RMDs a little bit more detail, and we can dive into what the tax implications of that would be and whether things like the charitable trust make sense, and we can dive into that in more detail. So with that, are we all good? Any additional questions? Uh, it's been a real pleasure working on your plan so far, and you're well on your way, I think, to meeting your financial goals. And it's great to work with clients who've already done this much work on their own. Um, and then finally, the last thing I want to just run by you is uh, now you have a copy of the plan, some of the documents. Um, I've signed the plan delivery acknowledgement. Basically, this just outlines what my responsibilities were here and kind of what I did in building the plan, as well as, I took the information you gave me as all truthful and above board, so I didn't go through a verification process on that. And obviously, as things can change, and if they change, um, as they change, please let me know, and we'll come in and re-update the plan. And here, just sign that and leave it for me, and you'll have a copy of this plan too. But with that, that's the end of our financial plan for today. As always, feel free to reach out to me by phone or email. And thanks for stopping in. It's been great meeting with you today.